Hello, Mark Ostfeld from ADM Investor Services International. And my thoughts this week turn to the Biden-Yellen fiscal package and its implications for financial markets. It's clearly something which is occupying people and is playing a role in the way that the US Treasury market is playing out at the moment. So my first chart this week compares the yield on the US 10-year conventional Treasury against the US TIPS yield. This is important. It's important in policy terms on both sides of the equation. Really what it tells us is we've had an upward adjustment in US 10-year yields and longer term yields, but it's not coming because of fears of inflation. Indeed, as one can see on the chart, the real yield on 10-year TIPS has actually dropped to its lowest level. Therefore, what we're talking about here is markets adjusting for prospective inflation, which is something which the Fed will basically not be unhappy about. We're back above, slightly above the 2% target level. Obviously, they're in an average inflation targeting regime, so that's not a big problem. But it really says that the rise is primarily due to hopes that the economies will pick up later in the year, and secondly, some adjustment with a steeper curve for extra fiscal borrowing. So next up, my chart is, my second chart looks at US federal debt against USM1. As one can see, there's been a very big jump, as we know, in US federal government borrowing, about $5 trillion for last year. And there's certainly with the prospect of at least another $5 trillion for this year, particularly given the package which has already been passed by Congress in December, another $1.9 trillion which is being proposed by the Biden administration, and indeed talk that the more infrastructure related package which will follow will be somewhere in the region of $2 to $3 trillion. As one can also see, US money supply has, which has traditionally been quite closely, growth rates have been quite similar, as one can see, this is a long-term chart, to federal debt growth, has exploded. And that tells us actually quite a lot, because that's all about central bank money printing. Central bank money printing is obviously creating quite hefty distortions in markets. So this brings me then to the next chart, which shows how the fact that central banks have been hoovering up all these government bonds is allowed a lot of corporates to borrow very, very heavily without actually, with the huge increase in corporate borrowing, both in the investment grade market and the high yield market, not really having a colossal amount of impact on spreads. In fact, the appetite for all of this, partly because of governments being, government bond borrowing, bond markets being crowded out by central banks, and therefore people looking for alternatives as well as better yields, tells us quite a lot about that. But it also tells us that there's a risk if central banks start to step back. My final chart relates back to the first point about inflation, and that's the Goldman Sachs Commodity Price Index. And as one can see, we've recovered largely to the sort of peak levels that we were at prior to the COVID-19 pandemic. There is a big spike going on here, and I think this is an important one, because if we actually have a lot more supply side inflation, i.e. due to production bottlenecks, due to production being insufficient as the global economy recovers, we may have something in the way of inflation which needs to be, which is considerably higher than perhaps central banks will want, and is far more difficult to control. Demand related inflation is okay, but if it's supply driven as well, then there are bigger problems. So some thoughts there on where we are going with government bond yields, and indeed the individual pressures that there are there.